we've established that you've got to keep your eye on profits, on earnings, in order to evaluate the stock market's potential. A question you may ask is, well, can we break that down even further? Is there something even more sensitive than profits or earnings that we ought to keep track of? The answer is yes. It's profit margins. Well, what's the difference between profit margins and profits? Well, this is helpful. Think of profit margins as the profit earned on the sale of one item. So what we're going to do is remove the sales volume, how many we sell, and just look at how profitable it is to sell one single item. And if you keep that in mind, that might be helpful to you in thinking of profit margins. And if we look at this chart, this is your chart 2.3, you'll notice indeed how volatile this chart is. And for most of the years, the growth is absent because once again the volume of sales is stripped away. All we're really seeing here is the profit per unit of output. Well, how do we come across a chart like this? Well, let's look at the background. This chart is really constructed kind of simply. What it does for the whole economy is just take prices, like wholesale prices, and divide it by the labor cost for each unit of output. So you get the price for each unit of output divided by the cost for each unit of output. Now, if you always divide price by cost, and the numbers would never change, well, you might think you'd have a ratio over the years that would move along at about 100, kind of a flat line. In other words, if you're looking at the change in price versus the change in cost, and the change in one is always matched by the change in the other, you'd think maybe you'd have a flat line all the way across. Well, clearly, it's not a flat line all the way across. Sometimes prices improve more than costs. That's great. Profit margins are up. Sometimes costs grow more rapidly than prices. Profit margins are down. So you can see there's a seesaw pattern with the business cycle. Sometimes profit margins up, sometimes down. Remember, it's the relationship between the price of the product we're selling and the cost of making it. And bingo! Look what happens in the 1990s, especially the late 1990s. Look how the profit margins soar. This is what told investors we're in a whole new economy. They said in the past, old economy. Now, new economy. The profit margins are going to go up relentlessly and forever, and that's going to justify pushing the stock market up to the sky. Now, we learned when we looked at charts 2.1 and 2.2 that, as a matter of fact, around 1997, 1998, the whole thing broke and profits weakened. Well, it's even more clear when we look at profit margins around 1997, they started to head south. And because they headed south, that was a warning to investors that trouble was brewing. And this was not just true for all corporations. As the next slide, 2.4, makes clear, it was also true for manufacturing corporations. And for manufacturing corporations, we have a measure of profit margins which is the simplest one of all, which is just how many cents, how many pennies did manufacturers earn for each dollar of sales. And you can see for years it kind of fluctuated between 4 and 6. Sometimes manufacturers would earn 4 cents for each dollar of goods they sold. Sometimes they'd earn 6 cents. And then in the late 1990s, we really broke out of that range. It was constantly above 6, sometimes hitting as high as 8. Wow, a new economy. But then stopped growing around 97, 98. The warning sign we were talking about.